Hi everyone. Let's talk about the Indian equity markets, where it stands and where it seems to be headed. Now, there are certain factors which are playing out, which is leading to this kind of volatility in the markets overall. Let's look at the positives first. If you look at the GDP growth rate expectations, it is one of the best across the major economies. Inflation seems to be contained. And at the same time, what we've seen is we look at the crude oil price movement. Now, that has been slightly volatile, but it's had a downward bias, which is a positive. So, that's definitely going to hold the Indian markets in good stead. Now let's look at the balancing act. Where are the concerns lying right now? What we saw was the corporate earnings have just started and they've kicked off on a weakish note. Now this is important to remember that it's following the FY25 results. Now the market is really expecting corporate results to start picking up in the second half of the year. That is where some bit of a consumption revival is also expected to play its role in helping the overall economy. What is also important to understand is in terms of valuations, the Indian equity markets are in between. So what we mean by that is it's neither very expensive nor very cheap at the moment. On the flow side, what we've seen is RBI really has been able to inject some bit of liquidity. What is important now is the set of factors that we need to keep tracking on a continuous basis. So some of the most important monitorables for the Indian markets, we start off talking about the Indian corporate results. On the other side, we'll also have to keep an eye on the central bank commentary across the globe. At this stage, one of the important overhangs that we cannot ignore is the fact around the US tariff implications. So while things were supposed to be settled by first to second week of July, what we've seen is there's some bit of buffer being given. So by first week of August is when we expect these tariff uncertainties to really settle down. Now, from the Indian perspective, in the short term, we expect the volatility to continue in the Indian equity markets, maybe with a positive bias. But the real opportunity will unfold in the second half of the fiscal year, where we expect the corporate earnings to really go through, partially helped by the low base of the last year and also by the consumption breakthrough that we are expecting in the second half of the year. So our advice for you would be to stay patient, stay focused, and use any opportunities in the market falls to create a good portfolio for the mid to long term. Wishing you all the best. Thank you.
Today I'll be covering on the fixed income perspective. Let's start with the US market. The Fed in its June policy maintained the policy rate at 4.25 to 4.5%. This is a fourth consecutive meeting when the Fed has maintained the rate. This also depicts a cautious policy stance by the Fed. This has resulted in an elevated USD yields. The 10-year USD yields have been trading in a range of 425 to 450%. If we look on the other aspect, the US PCE inflation data has remained above the target 2% level, and also the GDP growth in the first quarter has contracted. The inflation numbers have been very benign. The May inflation number has been at 2.8% year on year from 3.2% in April. And this trajectory has been a favorable factor for India. Financial year 2025 and expected lower GDP growth, RBI in its June monetary policy front-loaded a 50 bips rate cut, a reduced cash reserve ratio by 100 bips in a calibrated manner starting September, and change the policy stance from accommodative to neutral. However, this led to the bond yields rising, particularly in the ultra-longer end of the yield curve. However, the 10-year GSEC yield remained range-bound in 6.25 to 640 level. The ultra-longer yield curve rose sharply. We see fixed income market to be an interplay of global and domestic factors. On the global factors, Fed policy, new tariff, and crude price movement would play a crucial role, while on the domestic factor, the GDP growth, the inflation trajectory, and how the monsoon pans out will add further levels to the macro factors. With front-loaded rate cuts now behind us, we anticipate RBI to be on a hold and watch policy in its, at least for its next two policies. We see that going forward, if the growth comes down or the inflation remains benign and the global factors are conducive, the RBI has a leeway for one more rate cut about the macro factors, including the Fed policy rate and what impact does the new tariff brings into the market.